Imagine waking up to the headline, "Central Bank Cuts Interest Rates Again." Your phone buzzes. One friend says, "Finally, time to buy that house." Another sighs, "Guess my savings will earn even less." A few numbers on a government website just changed everyone's lives, from your car payment to your future plans. So, are interest rates really going down? And if they do, what does it mean for your wallet, your debts, and your dreams? Let's unpack it, clearly, calmly, and practically. Interest rates sound like something only bankers care about, but they quietly shape everyone's reality. They decide if your first home feels within reach or slips away, if your credit card debt grows or shrinks, if your savings actually grow or just sit there doing nothing. After years of painful hikes to fight inflation, whispers of rate cuts are getting louder. But cheaper loans aren't always a win for everyone. Lower rates can help borrowers, but hurt savers. So let's break it down in simple terms. Think of interest rates as the economy's thermostat. When prices rise too fast, the central bank turns the dial up. Higher rates make borrowing expensive, cooling things down. When the economy slows, they turn it down, cutting rates to warm it up again. It's a delicate balance. Too hot, you burn. Too cold, you freeze. After the pandemic, rates shot up to control inflation. Now, in 2025, inflation's easing, and the world's asking if the next move is finally down. Here's the good news. When rates fall, loans get cheaper. Banks lower the cost of mortgages, car loans, and business financing. If your home loan is 7% today and new ones drop to 5%, that's thousands saved over time. People start borrowing more, spending rises, and the economy feels more alive. But there's a catch. If you're on a fixed rate loan, you won't feel the difference until you refinance. Only variable rate borrowers see instant relief. So if cuts are coming, it might pay to wait before locking in. Timing really can be money. Now the downside. When rates fall, banks also cut the interest they pay on savings accounts, deposits, and bonds. That 5% account might quietly drop to 3%. Your money grows slower, even as prices still creep upward. It feels unfair. You're saving responsibly, but earning less. That's why investors often turn to stocks or real estate in search of better returns. Still, there's a silver lining. Lower rates mean cheaper refinancing. You might pay less interest overall, freeing up cash for what matters more. You earn less, but you might owe less too. Falling rates spark a chain reaction. Businesses borrow more easily to expand and hire. Stocks often rise, since investors expect better profits. A weaker currency can also boost exports, helping manufacturers. But it's not always a happy sign. Sometimes rate cuts signal concern, a slowing economy in need of a boost. Ultimately, it's about confidence. If people feel hopeful, they borrow, invest, and spend. If they're anxious, even cheap money can't move the needle. Behind every rate cut or hike are human stories. When rates rise, families delay dreams. When they fall, those dreams feel possible again. A new car, a home, a small business. Money isn't just math. It's emotion. It's stability, freedom, and hope. And every rate decision touches those feelings in a different way. Interest rates don't just move economies, they move confidence. And confidence is what truly drives the future. If rates really start dropping, things will move fast. Loans get cheaper, yes, but so does time. Opportunities appear, markets shift, and choices matter more than ever. Maybe it's time to rethink your loans, your savings, and how your money's working for you. Because every rate change hides a chance for those paying attention. What if your money actually worked for you, not against you? Maybe it's time to rethink how you see the future. Here's where things get interesting and often confusing. When interest rates fall, the world of investing shifts in subtle but powerful ways. Stocks, bonds, real estate, they all react differently, sometimes even unpredictably. Let's start with bonds. Bonds are like IOUs from governments or companies. They pay a fixed interest, say 5%. But if the market rate drops to 3%, that old bond suddenly looks amazing. Everyone wants it, so its price goes up. That's why bond investors love falling rates. their older, higher-yielding bonds become more valuable. Now look at stocks. Lower interest rates mean companies can borrow more cheaply. They can invest, grow faster, and post bigger profits. Investors, hungry for returns, often pour more money into equities. Stock markets rise, sometimes sharply. But there's another side. When rates fall because the economy is weak, stock markets can be nervous too. They might rally briefly, but deep down, investors know rate cuts are medicine for an economy that's feeling unwell. And real estate? Lower rates usually make mortgages cheaper, so more people buy homes. Demand pushes prices up, builders get busier, and real estate often thrives. But if rates fall too far for too long, bubbles can form. Homes become overpriced, and the cycle can eventually reverse. It's like the tide going out. For a while, everything looks bright and exposed, until the water rushes back and you realize who was swimming without a life jacket. Interest rates aren't just about numbers. They quietly decide the rhythm of everyday life. A family deciding whether they can afford a new car. A student wondering if a loan is worth taking for college. A retiree calculating how long their savings will last. When rates go down, these decisions shift. Suddenly, buying feels easier, but saving feels less rewarding. It's a strange paradox. The very thing that helps some can hurt others. And that's why policymakers walk such a fine line. Cutting too much can fuel inflation or asset bubbles. Keeping rates too high can choke growth and cause job losses. In essence, central banks are trying to choreograph an invisible dance, keeping millions of people moving in sync with the economy's rhythm. Too fast or too slow, and someone gets left behind. Every rate change isn't just a number, it's a story. When rates were high, families paused dreams. They waited to buy homes, skipped trips, delayed plans. When rates fall, that tension softens. People start imagining again, taking steps toward what they'd put on hold. But uncertainty always lingers. What if rates rise again? What if savings stop growing? Money isn't just math. It's emotion, security, pride, hope. Each rate cut or hike touches that core in a different way. Because interest rates don't just shape economies, they shape confidence. And confidence drives everything else. Look back through time. Rates have swung wildly. From nearly 20% in the 1980s to near zero after 2008. Each swing told a story of inflation, recovery, and reset. When rates fell too far, bubbles formed. When they rose too fast, recessions followed. Yet people always adapted, refinancing, diversifying, finding opportunity in between the extremes. So maybe the real question isn't if rates go down, but what you'll do when they do. Because every shift in the economy hides a personal opportunity, if you're ready to see it. If rates start dropping, the landscape will change quickly. Loans get cheaper, markets move, and new possibilities open up. This isn't a time to panic. It's a time to pay attention. Maybe it's time to revisit your debt, your savings, and how your money's really working for you. Because knowledge, not luck, is what compounds over time. So, as the world waits for rates to fall again, ask yourself, what if your money finally worked for you, not against you? Maybe it's time to rethink how you see the future.